Well, now here we are again. Thank you for clicking on this video. My name is Good Joseph. Post a video about money, investment, anything related to that. And by the way, if you don't want to miss one of my good videos, make sure that you subscribe down below there. Anyway, today we are talking about how safe do we invest the 300,000 all the way to 500,000. If you have a money that is within that bracket of 300,000, let me put it on the board, all right? So if you have a money that is around 300,000 to 500,000, so how do you invest this money safely? All right. And by the way, this is in terms of Kenyan shillings. And I know you're like, okay, give us in terms of dollars. This is like $3,000. Okay. This is like $3,000. Now, how do you invest that amount of money? How do you go about it so that at least you can do something as far as your life is concerned? All right. Now, this is the point. See, you have to really understand some of the nitty-gritties about yourself. So the very first thing to do when you have this amount of money, don't even think what you can invest on. First of all, know who you are. I repeat, see, the first thing that you do when you have this amount of money, don't even think what you're supposed to invest on. Think about who you are. Why? You can give person A, B, and C. These are different people. Why? Because when I say person A, B, and C, I'm saying or I'm defining these people based on what we call the risk tolerance. Risk tolerance, okay? See, how much risk can you tolerate? Who are you? Do you feel like more inclined toward the businesses? And when I say businesses, I mean these things like restaurants and all those kind of things, okay? Those are businesses. So do you feel like you're an individual who, hey, you know, this amount of money, I don't want to risk it. Maybe you're an old person somewhere, let's talk of 40, 45, 50, almost that particular age, and you feel like, I do not have the time for business. Are you employed somewhere? Do you have an existing cash flow as the time goes by? You get the thing. Is it the only money that you have? See, these are the questions that you need to ask yourself. Okay, first question is who you are. Ask yourself who you are. Okay, how much risk can you tolerate? Say, number two, for example, if you are young, let's say at your 20s, there's people who at 20s, they get this amount of money. If you're at your 20s, you can afford to take more risk because you have the time, you can as well make this money again. Number two, before you go to the point, okay? Number two, you have to understand things to do with, now, do you have an existing cash flow? Do you have an existing cash flow, okay? So if you do have an existing cash flow, then it means even if you were to risk this amount of money, then it means like, hey, guess what? You have a soft landing at the end of the day. Is it the only money that you have? Okay. Number two or number three, what experience do you have? See, sometimes I tell people when you want to invest this money or whichever the amount of money, don't go. For example, I had a friend of mine who was employed somewhere where he was dealing with meat vendor. In Kenya, we call it butchery and such kind of things, okay? And that guy got at least 150,000 Kenyan shillings, 150k. And the guy had passion about clothing industry, fashion, and what have you. So the guy had all the experiences to do with meat, selling meat, and all those kind of things. Yeah. Now, guy got the 150 Gs. Go ahead and put that things to do with clothing. It backfired. He lost all the cash. He went back to employment. And I asked the guy, why would you go to the clothing industry? Yet you're already aware and you're good conversant well with things to do with meat and what have you. He said because of passion. So do not overly follow your passion. Follow what the ground says and what you have an experience on. Fine, enough with that. Let's get the business now. How do you invest this amount of money? Okay, and investing this amount of money, we're going to divide it into several sections. Okay, number one, first of all, let's pick a flat rate here. Let's say you have 400k. Let's say 400k is what you have in your pocket. 400,000 is what you have and you want to invest this amount of money. So the question is this, after answering all these questions, let's say maybe this is amount of money you have somewhere, you're looking for, you do not have any other money, it's the savings that you have. Let's say maybe you're working in Gulf, you're thinking of coming back in Kenya with this amount of money and you want to invest because you want to eat and do all those kind of things, okay? I would say divide this money into 4 categories, or you can divide this money into 3. How? You take the first section of this amount of money, which is 200k, okay? Put it in what we call a high-risk investment, or business or what have you. Now you're remaining with the 200,000. 200,000, subdivide it further. Get 100k. Now this put it in what we call a low risk. This is now what we call the low risks, okay? And then the last 100k, leave it in liquid. But obviously when I say leave it in liquid, kind of consider it like a sort of an emergency fund. Not really an emergency fund, yeah, but you can call it like an emergency fund or something of sort. But obviously don't put it idle in a bank. So you put it in something like an MMF where it is earning you something at the end of the time. So you have not only saved this amount of money, but at the same time that money is subjected to growth. So the first high amount of money, which is 200,000, you put it in a high risk investment or high risk that has high returns. For example, you can set up a business, a normal business. See, there are people who are good at selling cereals. You can set up, like, let's say, a baby shop. You can set a beauty shop. You can sell a spa. You can go ahead and start, you can get yourself into variety of investments, okay? There's some people who take this amount of money and go purchase a car, Not really, it can't purchase a car, that's obviously, but you can do a deposit and maybe get yourself like a 650cc car, and you can get yourself into taxi, you can get yourself into Uber, and then you subject yourself into repaying that amount of money back. But it depends. Do you understand the business? Now, the point is, the 200 Gs put it in a quite of a risky affair. At that particular point, you start to gain more. But at the back of your head, as much as you start to gain more, things can go south. Now, the 100K that you have, this is purely for investment. This one you can purely pick, maybe you can pick a bill. You can pick a bill, okay? Because you do not know how this business will fare up. You see why I'm telling you to divide this amount of money? Let's say you get into a baby shop business. So you set up a baby shop business and the business is doing good. This is where you're selling things to do with the diapers, you're selling like serviettes, you're selling tissues, the personal effects and the hygiene, the toys and what have you. Let's say the business picks up. Okay, and the business is doing good. See, you need funds to pump in more money into that business for it to grow. So you need to have a little bit of cash at your disposal hidden somewhere. And that's why I said you divide this money into two. But there is one section of money I don't want you to touch. This money that is 100K, you're putting it purely into an investment. You can put it in a treasury bill. In Kenya right now, the treasury bill goes for 16.7 something percent. So if you put 100 Gs in that investment, wow, that's an amazing thing. So once the treasury bills matures, you can do the rollover. You can do the rollover. Or if you don't want to go the treasury bills way, you can go the treasury bonds way. Again, it's playing around that percentage. So you put that money in treasury bonds and you fix this money, let's say in 2 year, 3 year or something of sort. So when that matures, if you really don't need that cash there, you can pour it back into investment, So you already at the back of your head, there is 100K somewhere that is giving birth to small baby money, and I'm able to progress that way. All right. And then remember, there is this 100K that you need to do or you need to have. Okay. Now this 100K that you have, I said you put it in an emergency fund. So if you put it in an emergency fund, but now this emergency fund, not just a fixed account, not just an account anywhere. This is an MMF, a high return account. You see, put it in a fixed account, they give you like 6% or 6.5%. That's not a good deal. Okay. Put in somewhere is giving you 10, 12, 13, 14, 15. Okay, are we together? Now, if you put that in a money market fund, now, the one that I said you put it purely in an investment, don't think about it. But this 100K, you should actually open your eyes. Now you start comparing the two. You start comparing the two. Now you ask yourself, this one that I'm having as an emergency fund, it depends. Maybe the business is in a position whereby it can't feed you. You see, when you open a business, for example, we usually have what we call like three levels of profits. We have the expected profit or target profit. This is when you set up like 200K. Let's say if you set up a business, this should give you around 1,000 bob per day, or maybe say, yes, let's talk over 1,000 to 2,000. Sometimes can even give you 3,000 a day, but depends. It is not overly true that whatever I'm giving you as a theory has to be mirrored on the actuality on the business. Okay. Now let's say this business, the target profit is like, let's give it 2%. Okay. Rather 2,000, okay? 2,000, that's like a 1% per day, 1%, but sometimes it violates that 1% of the total amount of money that you invested. So now the point is, this is your target. Now, say you don't get this target. Say maybe you get less than this. Listen, what if maybe you get something like 1,200 a day, 1,200 a day. So now this target, we call it the mid-tier target. Okay, and then what if you don't get the mid-tier target? What if you get the lowest target? What if you get something to do with 700 all the way to say 900, or let's say maybe to 1,000? So the question is this: now, can this business operate? Now, this is what we call the low range. Okay, now the question is this: if the business can survive with the lowest profit, it can be able to pay its operational cost and maybe do something a little bit for you, in terms of surviving, because this is where I want to eat. And I'm giving an example of an individual who comes to Kenya, maybe say from Gulf or from any given country out there. You show up to your country, maybe you're a Nigerian, Zimbabwean, or whatever the point is, just by the concept of what I'm giving here, okay? Now, if the business can actually survive on the lowest profit, then that's a worthy business to start it. But let's say maybe that something is not going good. Maybe the first month the business is need. The second month, business absorbs everything that it makes. mistakes, therefore you cannot be able to survive. Now, this is where you go to survive. Again, I'm using an example of an individual who do not have any other source of income. If you do have an existing cash flow, maybe you're employed somewhere, or maybe you have some other things that are actually giving you some cash, you can survive on that. Don't touch this amount of money. So if you do not have anything, think about this amount of money. If the business is not asking you, again, don't forget, in business we have 3 levels. First level is when the business is giving you what you expected. Number 2 is when the business is not giving you what you expected. It is neither asking you something from your pocket. Let me repeat. We have 3 classes of business. Number 1 is when the business is actually making you the profit. It may not be the profit that you're looking for, but the business is making a profit. Number 2 is a business that is neither making a profit nor a loss. The business is not asking any money from your pocket. The business is sitting on fence. It can tilt either way. It can go the profit way, it can go the loss way. So at that particular point, you need to be very, very careful. And then we have the toxic business. Now, the business that is on the red line. The red line is a business that is neither making a profit and it is asking money from your pocket to actually salvage it, to sustain it. At that particular point is when you think about this money. But if the business is either sitting on fence or the business is making its own cash, and if maybe that cash is not enough for you, at that particular point, don't touch this money. But then if you realize the business is doing good and the potential of the business is being choked by the fact it does not have enough capital, now you take the 100k and pump it into that business. The 100k that you take is not this one that you did put in bills and bonds or whatever. The 100k you take is the one that you did put on an emergency fund. You get the thing? So now you take that money. When I say an emergency fund, don't view it from a point really as an emergency per se. View it as allowing potential capital somewhere just in case you need to pump in more money to your business. Now, when you actually incorporate that, then that way you are able to take some money here, pump in more money here. But do not have this assumption. There is an assumption that I usually see people doing. Yeah, they tend to think like, hey, my business is not performing good because I do not have the capital or I do not have enough stock. Ask yourself, what if you were to bring more stock to that business? Does it mean by default it will actually perform better? Because you can even go take a loan, pump in more stock into the business, but the business was a wrong idea. Maybe the location was not the best. Maybe all those kind of things are not the best. Okay, so the point is, make sure that you understand the business first before you pump in more money into that thing. Okay, now at that particular point, let's say something goes south. Let's say maybe the business doesn't go good and it disappeared, collapses, and what have you. At least you are left with 50% of the money that you had. The mistake that I usually see most of the people do, especially the person who does not have any other cash, is taking the whole chunk of 400, putting it in a single investment, and then you bank on that investment. You do not have an existing cash flow. You do not have an emergency fund. You have nothing. See, you're not only putting your money at risk, you're also putting your family at risk. Can you imagine being in a situation whereby you just got out of the country, you came back with 400 Gs, you put it, let's say, in farming, and then something goes south. Then if something goes far south, guess what? You do not have the investment, you do not have the money, and say maybe you have a family. The family is at risk. So at that particular point, it's always good to see. This is when we say you test the depth of the river with a single feet. Don't go there with the both feet. You see, because if it's deeper, then you're gonna drown. But if you put a single feet there, you see, as you learn. But again, don't put a single feet there and then you deny some funds into the business. Remember one thing, businesses survive on vitamin M, and that is cash. So you need to be an individual who knows when and how to actually pump in more money into this business. That is exactly what you're supposed to do. So when you differentiate that amount of money that way, you're going to do something and grow yourself. But the point is this. First of all, you can only make these kind of decisions if you understand who you are in terms of how much risk can you actually tolerate. Number 2, do you have an existing cash flow? Because if you do have an existing cash flow, you can even pump in like 300 Gs and start with here. Number 4, you can even go ahead and top up with a loan on top of that because you already have an existing cash flow. Number 5, what are your experiences? What do you understand in terms of the business? Have you ever been to this business before? What do you know about it? All those nitty-gritty. So when you have a concoction of all those kind of things and understanding, not just starting a business because you have the cash, because that is a very worst thing that you can ever do. So that way, when you have that understanding, then that's gonna help you in making a right decision that's gonna propel your growth as far as the finances are concerned. See, have you watched this video to the end? Thank you very much. And by the way, I know you're thinking, okay, fine, Joseph, I may not have the 300k. I have less than 200. I have like maybe 50,000. Joseph, I have 1,000,000. I have 2, I have 10. So how can I get in touch with you? Sure. My number is always on the description of this specific video, just below where I have the number of views, just below there. Click more. You're gonna see my number or my email there. Shoot me a text or an email, or text me on WhatsApp. Let's talk about businesses. I offer those services at a personal level for just a cup of coffee's price. For now, it's a goodbye, but don't forget, hit that like button, subscribe, and also comment down below. Tell me what you think. For now, it's a goodbye, and see you in the next one.